Everything in this video is not intended as financial or investment advice and is for educational purposes only. I'm Josh Olszewicz, the head of research at Valkyrie. And let's take a look at the midweek market update. And we have another month, another Fed meeting. This is the meeting probability list here. And as you can see for this week, we've got a near 100% probability of a 25 basis point hike, with a high chance of a 25 basis point hike to follow that on March 22nd, where the probabilities are currently holding at around 5%, with some high optimism that we will start to cut rates, a true pivot, not a pause, but a true pivot by the end of the year. The market remains optimistic on both the pause and the pivot, considering the inflation data is still above 5% based on what I can see. Now that isn't forward projecting, but current data does suggest a year-over-year inflation at around 5.5%. We'll see what that looks like in a month, but inflation decline is waning, meaning if inflation remains above Fed funds rate, the Fed will have more ammo, more evidence to keep cranking. Now, obviously, that's not the only thing they're looking at. They're looking at unemployment, general health of the economy, PCE, ECI, right, all this stuff. So it's not as simple and cut and dry as inflation going down, Fed pausing, but that's how the markets are certainly acting. And along with the Fed this week, we have BOE and ECB. Because of the way, this is the DXY, because of the way the DXY is made up, it's a basket against the euro, against other currencies. So we may see continued weakness on the DXY if we are in those pausing periods, while the Eurozone, which I just saw, inflation 17% year over year on groceries today, that data came out. So they have a while to go, and it appears they are still dealing with inflation to a much greater degree than we are here. So if we start to see that imbalance in rates, we may see continued weakness in the DXY. This is a weekly chart. This is a multi-month idea. I'm sure I'll revisit this at a later date, but the end game here is 90 or thereabouts. Historically, that descent has been bullish for digital assets. These red bars here are Bitcoin halvings, the next halving for Bitcoin somewhere around May 2024. So that does align decently well. You know, we can stay around 100 for many months, start declining into halving. That would be super bullish for digital assets. At least it has historically. Here's Trueflation now. You can see Trueflation, which measures daily millions of items, throws it on the Chainlink blockchain, and gives us a number. Had been declining rather significantly, and that has leveled off really since December, or we've held with that 5 handle for quite some time now. So, you know, this is daily, this changes rapidly, but the rate of change has slowed and appears to be flattening here, which will be problematic for the Fed. Not necessarily this meeting, but after the next couple CPI prints. The next CPI print is February 14th on Valentine's Day, and we may get some interesting market reactions. You know, this data is freely available. Everybody can look at this, but there's just something about the CPI print the day of that really gets the markets going. Today's print was ECI, or the Employment Cost Index, which did show a slight decline, 0.1%, measured quarterly. So if you're the Fed and if you're looking for reasons to pause, this may help them, right? Depending on how they would want to use the data in their favor or not, this is something that they could use. And again, 25 basis points, fairly certain that's going to be the hike this week. That's, by the looks of it, priced in, highly expected by the market. Anything that deviates from that would probably bring increased volatility, let's say. And looking at today on that ECI print, you know, correlation isn't causation, but markets did close rather strong, did reverse on the day around that print when that came out this morning. All the technicals still apply as they did in the previous week. Fundamentals look bearish to many, recessionary conditions, etc. The technicals, on the other hand, continue to print a bullish narrative. We are above the 50 and the 200 moving averages here in the green and red. We are above the daily cloud. We are drawing this chart pattern fractal known as an inverted head and shoulders, which has a resistance level around 4,100. which says, look, if we start to get above 4,100, really what you want to see is an on-volume breakout or a sustained breakout. But if we start to see that, then there is a high likelihood that we will attempt a move higher, which doesn't seem very likely considering all of the potential fundamental news coming. But the technicals are favorable. This isn't, an overnight trade by any means. This could take 6 months, a year, but that is the technical target for this multi-month setup here on the SPX, which again should be pretty bullish for risk assets. Something else the Fed probably taking into consideration here, depending on how you want to measure liquidity. I don't want to use the word index, but this is one way to measure liquidity. Looking at the Treasury General account, looking at reverse repo, and it has been rising. It continues to rise, staying within this tight range. You can see this is pre-COVID, right? Pre-COVID, we're down here, right? So if QT is truly going to happen or needs to happen at a massive magnitude, it's going to take some time to return back to those levels, pre-COVID levels. Now, if we look at other indices, fertilizer, freight, housing, most of those have returned, although housing has perked up a bit this month. Most of those have returned to close to their pre-pandemic levels, right? Liquidity will take some time if it does in fact reach those levels. But currently, we're basically at the same liquidity levels we were in early 2022. Not too much has changed on that regard. And yields are still as inverted as they were, 10 and 3 inverting even more. So, it, again, depends on how Powell wants to massage the data or how the Fed wants to comment on data like this surrounding their rates decisions, but it isn't getting any better in that regard. Now to an interesting topic. We haven't had a lot of governance drama around Bitcoin in quite some time. This is fairly complex, but also fairly simple when you think about how a network runs. Over the past few days, there has been this NFT project, which is referred to as inscriptions on Bitcoin, where users can effectively mint NFTs on Bitcoin. And some people in the Bitcoin community are very up in arms about this because there is a risk that we will increase block size, fill the chain with nonsense, cause the chain to move towards increased centralization, and then that kind of defeats the whole purpose of why we're here. That is sort of the nth degree of possibilities here. This is a graph of average block size. So every 10 minutes, there's a block. With that block, there's an associated size, and then it's added to the chain, right? So over time, if you're adding meaningless data infinitely, you basically just collapse the entire chain. We've seen this on other proof of stake chains that require very low fees or zero fees, and you have spam transactions, you have nonsense going on, right? But the question is always, who's going to be the judge and determiner for whether or not something's nonsense or whether or not something's viable, or, what's nonsense to me might not be nonsense to you, etc. So it's a very slippery slope when trying to judge that stuff, which is why if you're paying a fee, most people argue that you're not spam, you are a viable transaction, right? So currently block size is around 1.2 megabytes, and we've gone through this block size wars discussion. What can we do to the chain to improve fees? We've added SegWit. SegWit has an 86% plus adoption rate. Most transactions are using SegWit. Fees are very low most of the time. Most of the block space is empty most of the time. Much of the block space, I should say. So the reality is we do have some room to play around with block space. Obviously, nobody wants blockchain bloat where we're centralizing the network, and I'll compare and contrast that with ETH in a second. But that's the fear. This is the sort of description, I'll link this in the video below, of what this is, digital artifacts, description of what inscriptions are. And they go through it, how to mint it, how to use Taproot, right? A lot of this is pretty complex and not super easy to do, but it's available. And you're seeing all sorts of controversy from all sorts of interesting people sort of saying we shouldn't be doing this, we should be doing this. Others saying this is going to be a massive slippery slope. There have only been 355 issued so far as of, this morning, midnight yesterday. So we're not talking about thousands or millions of inscriptions here. At the current point in time, it's very minimal. But with NFT hype and mania, as it was last cycle, things would potentially increase fees to a substantial degree if thousands of these things are being minted every block. And again, that's another way of crippling the network in a sense, because if fees rise exceedingly fast, then you're pricing out a bunch of transactions that would otherwise happen on chain. So it's a very sensitive give and take whether or not this type of activity happens on chain. And again, there's been arguments from people, well, who are we to judge? As long as basically they're paying for it, we don't have to agree with what they're doing with it. There have been constant conversations about Bitcoin's security budget and what happens when transaction fees are the only security budget we have, right? So this all is part of that conversation. And you really don't want to be arbitrarily deciding which data is toxic and which data is not. So this is definitely an active discussion. Here's Bitcoin's block size. It is around 500 megabytes. Sorry, gigabytes. The chain size is gigabytes. The blocks themselves individually are megabytes. So you can see the rate of change here, relatively stable over time. The argument is, again, if we add this possibility to mint a bunch of stuff in the chain, then we're going to see nodes drop off. We're going to see the blockchain size increase exponentially, that sort of thing. And there have been calls to do this on side chains similar to Lightning, where we have this potential technology where we could use the side chain to play around with this instead of implicating the main Bitcoin network, which worries a lot of people. So there are decent arguments on both sides of this, definitely. And I'm glad people are engaged in having this argument. It says people care. People care about governance and people care about the future. So that to me is the most important takeaway of all this. Again, still a fairly active, evolving situation. But we have people like Jameson Lopp who constantly are looking at Bitcoin node and network health, because in order to sync a node, you need fast hardware and bandwidth. And some chains can only be run with industrial equipment and industrial network connections, and that is extremely limiting to who can run those nodes, and therefore centralizes the chain and sort of defeats the purpose entirely. So just to contrast with ETH a little bit, not every chain is the same, obviously, and ETH is different than Bitcoin in many ways. You can see they have different operating systems effectively for the chains that have been run historically. One of them was deprecated last year. They go through and prune data every now and then, and there's this argument of, unless you're storing the entirety of the chain's history, everything, then again, you risk centralization because you're relying on basically a third-party cache to catch up with that data. So this is very much data networking weeds and rabbit hole, but interesting when you're thinking about chain centralization. Here's the true total ETH full node, all history, all data, 13 terabytes and rising. So not many people have access to 13 terabytes of storage. Certainly more tech-savvy people do, hobbyists do. Not everyone everywhere in the world has access to 13 terabytes of storage. That's certainly getting easier and easier, right? But it's a bit of an arms race between storage and total size here. So it does risk increasing centralization relative to Bitcoin. And we can break this down even further, and we can look at the nodes. We can say, okay, how much of them are held on a hosted service, such as AWS, Google, Microsoft Cloud, right? And there is a centralization argument here because 62% are being hosted. So that leads some people to say, what's the point, right? And most of those are on Amazon. So many of the Ethereum nodes are hosted on Amazon Web Services, Google Cloud, Oracle, right? So you certainly lose decentralization points when you realize what's going on the node side of things. Another issue is, again, syncing nodes. This takes a high-speed connection. You need bandwidth. You need hardware. Not everybody has that. Some networks have trouble syncing nodes, period. Again, that centralizes the network because it requires industrial servers essentially to run. And at that point, what's the point? Here's ETH sync status of the nodes. You can see not all of them are fully synced, and you'll see varying degrees of this between different networks. I'm just picking on ETH here specifically because it's easy to do. The data is available. Many networks sort of hide who's funding those nodes to make it look like they are more decentralized than they are, right? So that's another issue you have to think about. So this NFT stuff on Bitcoin is interesting. It's controversial and asks all sorts of questions on why we don't have sidechains for this sort of thing already, because this sort of stuff is going to keep cropping up if we want increased utility on Bitcoin. If we don't, we're going to see that utility go elsewhere. Some would argue the utility we have now is perfectly fine. Decentralized, permissionless, 24/7, global, hard money. It does that extremely well. So we'll see. Actively evolving situation there. Talking about technicals here for Bitcoin, not much has changed week over week. We're still within a range. We're still looking more and more ready to flip the corner here on 2022 as we're above moving averages that we had been below strongly the entire year. We also have a 5,200 MA cross coming that we hadn't seen since the beginning of January. And currently the overhead resistance sitting at the 200-week moving average and the yearly pivot. Tons of volume here below us, which is a good sign for support. The MAs should also act as support if we decide to take a dive lower here. So we're currently kind of just crunching in between this range, and over the next couple months, depending on how rates are adjusted, let's say, depending on CPI, depending on the S&P, we may see attempts to breach this resistance at 26K. ETH also very similar, above key moving averages, above previous all-time high. ETH has been lagging Bitcoin a little bit here. ETH also has this growing argument for a diagonal support trend line here. So between the MAs, between the diagonal support, there's a pretty good case to be made that there are a confluence of support here around 1,500 for ETH. Current overhead resistance somewhere around 2K, also a horizontal. And really the longer argument, the multi-month consolidation argument for ETH is that it's in a potential Wyckoff-ian accumulation profile. Essentially, when you get a ranging zone with somewhat of a predictable price structure, you tend to get resistance tests when we're in this stage of the game here. So I do like that 2K level over the next couple months with the potential. This is the 2015 Bitcoin fractal for higher highs, right? And if you're just trading this from pivot to pivot, basically 2K to 3,100, multi-month trade, certainly very viable. So that's all I have for this one today. Let me know what you think of the Ordinals discussion in the comments below. This video is for informational purposes only, and the opinions expressed are not financial or investment advice. All opinions are my own and do not reflect the opinions of Valkyrie Investments and its affiliates. No fiduciary obligation or duty exists or is created between you and Valkyrie Investments or its affiliates, including me, by virtue of any opinions expressed in this video.